get started talking about Relative Strength Index, or RSI, one of the most popular trading indicators in the Forex and CFD markets. Now, the Relative Strength Index is a momentum indicator. It was developed by Wells Wilder, who's also well known for several other indicators, and it was published in 1978. Adjusted and adapted and tested now into all financial markets. So without going too deep into the workings of RSI, it is primarily used to attempt to identify overbought and oversold conditions when trading an instrument. Now, I gave you a handout, which I just completed. It's hopefully everything is spelled right and everything is correct, to help you understand where RSI comes from and see how to use it in your trading so you can get a better understanding. You still have to spend some time learning and mastering this, and then also using your risk-reward ratios and factoring it into your money management. But hopefully the handout will help you along the way. Now, how do you use Relative Strength Index? Now, RSI fits into a category known as an oscillator. An oscillator is a technical tool that we as traders use to give us an indication of whether an instrument is overbought or oversold. We use these overbought and oversold extremes to see in which direction the price action will have momentum. Now, oscillators are typically used in conjunction with other technical analysis indicators before making a decision to enter a trade. Now, there are a few oscillators like RSI, ROC, MFI, and of course, RSI is one of the most popular of all of these. Now, what one has to understand is you have to understand all the different types of indicators in there, because you don't want to use duplicates. Now, a lot of people, and we're going to look at some live charts and some live trading strategies tonight, but a lot of people use RSI and stochastics. Well, to me, I find it redundant because they both do the same calculations, give you market momentum, and give you overbought and oversold zones, and they both fit in the category called bounded oscillators or bounded indicators. Now, when Wells developed Relative Strength Index, it's called a momentum oscillator that measures the speed and change of price momentums. RSI oscillates between 0 and 100. When an indicator is locked between a zone, and most of them, a good deal of them are, and they always come out between 0 and 100, the mathematical calculations, they are called bounded because they're bounded in that range between 0 and 100. Some between 2 and 5, some between 1 and 15, but they're always bounded and they'll always come out mathematically within a particular zone or boundary. The other part of a bounded indicator is there is a level above and below that the indicator has to reach to tell you something. So for instance, RSI is considered or tells you the asset is overbought when above 70 and oversold when below 20. So the zone between 30 and 70 is like no man's zone. It doesn't tell you anything. Now, signals can be generated by looking for divergences, failure swings, and centerline crossovers. RSI can also be used to identify the general trend. Now, the calculation for RSI is not so difficult, although we don't want to do it by hand, but we could. RSI equals 100 minus 100 divided by 1 plus RS. And RS stands for the average number of days in the look back that the instrument was up or down. Okay. So to simplify the calculation and explanation, RSI has been broken down into its basic components. RS is simply the average gain and the average loss. This RSI calculation is based on 14 periods. So the standard RSI is 14 look-back periods. Okay, so if you're looking at a 15-minute chart or 15-minute candlestick, it would be 14 15 minutes. If you're looking at a 1 hour chart, it'd be 14 1 hours. If you're looking at a 1 day chart, it'd be 14 days. And we call it 13 look-backs and the current. So it's very easy to do the calculations. It just takes a bit of time. The very first calculation for average gain and average loss are simple 14-period averages. The first average gain is equal to the sum of the gains over the past 14 periods divided by 14. The first average loss is the sum of the losses over the past 14 periods divided by 14. The second and the subsequent calculations are based on the prior average and the current gain or loss. So it's the prior average plus this current one. So the average gain is equal to 13 plus the current time frame you're looking at. And the average loss is 13 periods back plus the current time frame. Okay. So it's not a hard, like I said, it's not a hard calculation. Okay. Taking the prior value plus the current value is a smoothing technique similar to that used in calculating an exponential moving average. This is also means that RSI values become more accurate as the calculation periods extend. Now, you could use a look-back period of 250 data points. Okay. It's up to you to how many data points we want to look back. But the look-back point in most cases is 14. And especially in the type of trading that we're doing, because we're trading in short-term periods. So going back 250 time frames really doesn't have any relative value to us in the type of trading we're doing. Now, Wilder's formula normalizes RS and turns it into an oscillator that fluctuates between 0 and 100. The normalization step makes it easy to identify extremes because RSI is range bound, like I said, a bounded oscillator. So RSI is 0 when the average gain equals 0. Assuming the 14-period RSI, a 0 RSI value means the price moved lower all 14 periods. That means price was steadily falling. There were no gains to measure. RSI is 100 when the average loss equals 0. There were no losses. That means the last 14 periods, the asset rose each of those 14 periods. It doesn't say how much it rose by. It just rose every time, so you never had a loss. So if you were calculating by the loss would be 0. So this means that all 14 periods were higher and there were no losses in that period. Now, as I said before, the default look back period is 14, but this can be lowered to increase sensitivity or raised to decrease sensitivity. A 10-day RSI or 10-period RSI is more likely to reach overbought and oversold levels than a 20 period. But the fact is, unless you're going to do all the studies yourself, you should use the standard look back period because all the strategies or the basic strategies, we're not talking about a strategy some gurus out there trying to preach you do this, do that, and do this. And he's adjusted his a 19-day look back period. That's his own strategy. It's not RSI. Okay, so let's go over and take a look at RSI on a live chart. And then we're going to go back and try to analyze what it's trying to tell us. So let me pop up some charts. So this is my standard gold chart for teaching class. Okay, as you can see, I've dropped the RSI indicator on the bottom. But the RSI indicator always is below the chart price. Okay. And it's very easy. There's nothing you have to do. All you have to do, whether you're using the ETX charts or you're using some other sort of chart, is locate the indicators, go down to RSI, Relative Strength Index, and click on it, and it'll put it right on your charts. Now we can see our RSI is, oh, I'm sorry, is using a look back period of 14. And it's using the close. This is the way it should be. Now, you can set the colors and everything else no matter how you want, make the lines thicker, but that's standard charting features. It's not an RSI indicator feature. So we can see that the RSI indicator has been dropped on the bottom of our charts, and we can see here the 100, and we can see here the 0 level. We can see the 30 and the 70 automatically marked off. I didn't do this. It's automatically done by the RSI calculations. And these are the purple area, the light purple area, is what I call dead man zone. Now, it does have some value to us. We're more concerned when RSI is above the 70 and below the 30. But we're also concerned with the center line, because as RSI breaks above the center line, it's telling you that the trend has momentum to upside. When it breaks below the 50, it's telling you the trend is losing momentum or moving to the downside. So there's some interpretations that we want to look at in this colored zone, but there's not much. Most people use simply RSI above 70 and below 30. Now, in the handout I gave you, all of this is explained to you there also. Now, you can see on my chart here on oil, where we've combined RSI, MACD, and DMI. Okay. These are 3 non-competitive indicators. They all 3 give us different information. Okay. But in this case, what we're looking at is, and we're going to talk about this shortly, is the divergence. Okay. The RSI indicator is making lower highs while price is making higher highs. That's divergence when the indicator moves in one direction, which is the RSI is making, like I said, lower highs, while the chart, the price chart is making higher highs. And we'll talk about divergence. And then we're going to go over to another chart with gold on it. And here we're seeing RSI again. And we can see the divergence here where the price is, in this case, making higher low. The indicator's making higher lows while the price is making lower lows. And here we combine it again with MACD and DMI. Let me just erase something here. Okay. And I'm going to pop up a short 1 or 2 minute video or a couple minute video to more explain the RSI, and then we're going to answer questions after that. So let's take a look at this for a second. So there we go, ladies and gentlemen. My friend Dave explained to you in his view, and I agree with him. Like I said, I use the 14-day, and I very rarely change indicators from the standardization unless I'm going to know exactly what to do. Like with MACD, I use a 2.5 instead of a 2, but that's because of years of trading. My advice is always to stick with the 14-day, because that way anything you learn out there and anything you read is based on the standard indicator. Now, there's a couple things we have to know. Overbought and oversold are often very, very confusing. Too many people tell me, oh, overbought means I should sell. Oversold means I should buy. But an overbought market or an oversold market can remain overbought or oversold for quite some time. It's just telling you that the buying has pushed the price up too high and it's too heavy. It's starting to get weighted down, but not that it's going to flip. It's imagine if you shoot a rocket up into the sky, you know sooner or later it's going to flip over and come back to Earth. But as it moves up higher and higher and higher, you can be sitting here watching it and say, it's going to flip, it's going to flip, it's going to flip. But because you don't know exactly where it's going to tip over, you're not exactly sure. So that overbought market is that rocket when it's starting to lose its momentum, but you're not sure where it's going to tip. Oversold is the exact same thing. Also, the 30 and the 70 are guidelines. Different assets and different markets don't always use the 37. Sometimes it might be better at 29 or at 80. You have to watch the RSI indicator for that particular asset and that particular market. I mean, you can see a market that's moving up, 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 and never breaks above that 80. But you see every time it pushes up to 70 in the mid 70s, well, you could say maybe this is more sensitive. Then you come to the point where you also have to start using personal interpretations. So like you see on this chart up on your screen of Apple, we see divergence. We also see lots of divergence, but we also see how it relates to price and how it relates to the 50 line. Okay. And there's only rules of thumb and guidelines as opposed to a set of rules that you must follow. But when you understand RSI and you've started to use it, you'll be able to see where or when you can expect some type of reaction. You can use it to help you get alert and predict. Now, as Dave was saying, you can also use it to set your stops. Now, first you have to use your risk-reward ratios and your risk management and your money management tools, because you can't just arbitrarily set a stop because an indicator told you to set a stop, because that's where you should set it, but you might not be able to afford to set it there. But if we look at the divergence here, okay, and we look at the divergence here, we see this asset's going to rally upward. We wait for it to break above the 50. Now, if we were to set our stop loss at that lowest swing low during that divergence period, that would give us, because if the market does what you suggest, it will never trigger that stop loss. So it's just a simple way of adding that into your trading strategy. Now, different approaches and different information works different in markets. So this approach can work well in ranging markets when the price is swinging back and forth between overbought and oversold levels. Okay. But if the stock doesn't quite reach the predefined levels, alternate levels can be used, such as 35 or 65. When a buy is triggered, a stop is placed below the recent swing low. A sell signal is used to exit long trades or initiate short positions, with a stop above the recent swing high. Now, during trends, now remember, there's three possible trends: uptrends, downtrends, and sideways trends. Sideways trends can be considered congestion sometimes. So we're talking about at this moment uptrends and downtrends. During trends, the RSI will usually stay contained within certain readings. During an uptrend, it typically bottoms above 30 and frequently reaches 80 plus. During downtrends, the indicator will typically top out before 70 and frequently reach the 20 or below. During an uptrend, buy if the price drops below 35 or 40 and then rallies back above it. So you want to watch the indicator. Just because it breaks a number doesn't mean to buy. You want to watch if it breaks and falls through and then bounces out of its zone. So if it moves above 80, falls back below 80, and moves back above 80, that's telling you one thing, where if it moves above 80 and stays way above 80, it's telling you something else. One problem with this strategy is that the RSI may not provide an exit signal, in which case a winning trade may turn into a loser. For such occasion, having a price target or another exit method is necessary. Now remember, when trading with indicators should always be your secondary method. They shouldn't be your primary method of trading. And remember, price action is ultimately the most important thing. But you should be using RSI with other indicators, such as support and resistance, trend lines, and maybe MACD. Because yes, you won't always get good stop losses and you won't always get exit points. They're just simply warnings. So you should have them calculated with other things. Volume would simply tell you whether that divergence is attracting the traders. So RSI is also used to spot divergence. We talk about this often. We talked about it before. We talked about it during Dave's video. We talk about it now because, as Dave said, divergence is probably one of the best things you can see. So bearish divergence is when price is rising, but the RSI is falling. It warns that the price could soon correct lower since buying momentum is slower. Divergence is not a timing signal, as it can last a long time. Rather, divergence helps confirm other signals and lets traders know when a trend may almost be over. Bullish divergence is when the price is falling and the RSI is rising. It warns the prices could soon move higher since selling momentum is slowing. Now, the RSI has several limitations, as all indicators do. Since the indicator is showing momentum, as long as momentum remains strong, up or down, the indicator can stay overbought or in oversold territory for long periods of time. Therefore, price analysis or some other confirmation is still needed for reversals. The same is true with divergence. While the RSI may be dropping and the price rising, that doesn't mean the price will drop soon. The RSI is just showing that the price is moving higher at a slower pace. Remember, RSI showing momentum. So every time you see RSI, think of that rocket, or not an outer space rocket. Think of that missile that got shot up in the air, or that firework, or when you shot something up into the air and you're looking for it to flip back over. So just keep that visually, because that's going to tell you exactly what RSI does. It's measuring the market go up, 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 and you'll start to see when it's losing that momentum, not necessarily when it's going to tip. Now, RSI ranges can help confirm trends, but each stock or market will have slightly different levels. One stock may repeatedly move to 38 on pullbacks, while others might go to 33. Therefore, some adjustment is often needed. The most basic RSI application is to use it to identify areas that are potentially overbought or oversold. Movements above 70 are interpreted as indicating overbought conditions. Conversely, movements below 30 reflect oversold. Now, this is an important component. The level of 50 represents neutral market momentum. Okay? The 50 line is not telling markets are overbought or oversold, but it's telling you there's neutral momentum. When it goes across above 50, it's telling you the markets are picking up momentum in the upside. When it falls below 50, tells you markets are picking up momentum to the downside. And this should correspond with the center line of oscillators such as MACD, which uses the same center line and the same 50. In terms of market analysis and trading signals, RSI moving above the horizontal 30 reference level is viewed as a bullish indicator, while the RSI moving below 70 is a bearish indicator. As with other momentum oscillators, overbought and oversold readings for RSI work best when price is moving within a sideways range rather than trending up or trending down. Wilder suggests that divergence between an asset's price movement and the RSI oscillator can signal a potential reversal. The reason is that these instances, directional momentum does not confirm price. The bullish divergence forms when the underlying asset makes a lower low and RSI makes a higher low. Bearish divergence is just the opposite. Now, as with overbought and oversold levels, divergence are more likely to give false signals in the context of a strong trend. Now, Wilder outlines another important indicator for the potential price reversal called failure swings. Failure swings are very important, and you have to see these. And remember when I said if the indicator breaks above 80 and it falls back and under the 80 and falls and then goes above the 80 again, or pushes above the 80 and keeps staying above the 80 or the 70, depending on which one you're using, it becomes important. So a bullish failure swing forms when the RSI moves below 30, rises back above 30, and then pulls back again, but holds above the 30 level. So in other words, RSI fell down to 27, moved back to 34, pulls back down again, but only pulls down to 31. Doesn't fall below the 30 again, but fell below where it was. The failure swing is complete when the RSI breaks its recent high. This breakout is interpreted as a bullish signal. And to me, these failure swings are more important than the 30 and the 70s. Okay, breaking above or below. When you see the failure swings, bullish or bearish, they are telling you something very specific. A bearish failure swing forms when RSI moves above 70, pulls back below 70, and then rises again, but holds below the 70. In other words, RSI shot up to 84, fell back down to 69 or 68, moved back up to 70, and then fell back below that again. And that's a bearish signal. Bearish in the instance RSI moves above 70 in overbought territory, and then it moves back below 70 and reverses upward but remains below 70. RSI then falls again and breaks below the prior case, in this case, the 62.52 level. So you can see it right here where I've got it circled in gold. That's our 62 level. This is our 80 level. This is our 70 level. We see RSI push above, falls down below, goes back into the range here, pushes back up, but it can't break out of that range, and then falls back up below the lowest it had reached in the previous. Follow me? Let's do it again. The red line here only denotes the lowest point RSI had gotten, which is right there. So we saw RSI moving up. It broke above the 70 level and moved all the way up here to right under the 80 level. It reversed and fell down below, back into the below the 70 level, and came down here, and the lowest point it hit was the 62.525. It then moved off of there and moved higher, but was unable to break out of that 70 level, and then fell back down. So you get the reversal point when it breaks this 62.5. That was the lowest point it had reached before, and generates a bearish signal. Now these are much more reliable. They're harder to spot, they're harder to read, but when these happen, these failure swings, they are very reliable. So as mentioned in the above interpretation of RSI, it is more reliable indicator in a ranging market and can give misleading signals in a trending market. However, a modified interpretation of the RSI can be used in a trending market. For example, during a strong trend, RSI might move only between the levels of 40 and 80. In such a case, RSI falling to 40 can signal a potential reversal. This is why you have to see the market, see the asset, look at the charts, and see how that indicator has worked. Because you can have the euro US dollar can be right on at 80 or 70, where the pound Japanese yen could stay all the time below 62. Okay. So you have to understand how that particular market is working. Trend lines can also be used for RSI oscillators themselves. So we can actually draw a trend line through the oscillator, the same way as we do price chart, connecting higher lows in an uptrend and lower lows in a downtrend. Breakouts above and below these trend lines can serve as to indicate a potential reversal in price. So again, we have another way of looking at finding information from the indicator. Now, when traders first learn about RSI and other oscillators, they tend to gravitate towards overbought and oversold values. While these are intuitive points to enter into the market on retracements, this can be counterproductive in strong trending environments. RSI is considered a momentum oscillator, and that means that extended trends can keep RSI overbought and oversold for long periods of time. But as you've just seen, there are many other ways: failure swings, divergence, okay, and breakouts. And remember, watch the center line. The 50 line tells you the price momentum. So all oscillators have center lines, and more often than not, they become a forgotten backdrop compared to the indicator itself. RSI is no different, with the center line found in the middle of the range at 50. Technical traders use the center line to show shifts in the trend. If RSI is above 50, momentum is considered up, and traders can look for opportunities to buy the market. Okay, again, go back to the fire of a rocket. Okay. Remember all those U.S. rockets that were fired off from Cape Canaveral and Cape Kennedy now? Okay. And we'd all watch them on TV back in the days of our black and white sets or beginning color. And we'd see all that engines, and all those smoke screens. We'd see that rocket start moving up. There's a point when it lifts off above the technical stuff that's holding it up, and it takes off and it has some momentum. You see all the crowd roar because you knew it actually had taken off, because it could have fallen over at any time. This is when it's breaking the 50 line. At that point, it's got the momentum, the power to continue moving upward. Okay. So again, always just think of this rocket and keep an eye on the center line. Because the bottom line is the RSI is popular because it has multiple uses. It is used to find entry and exit signals based on overbought and oversold readings and trending ranges, and can help spot and confirm reversals via divergence. Like any other technical tool, though, RSI is prone to give false signals. Price analysis is still needed to determine if a trend is present, and then important RSI levels identified for that particular security. And on that note, I'm going to say goodnight to everybody. Thank you very much for joining us. Hopefully you've learned a little bit tonight. Hopefully the little handout guide will help you along the way. And thank you for supporting ETX. And we'll talk to you again tomorrow evening. Good night now.